Market participants are looking to the upcoming union budget with expectations of policy stability and targeted tax rationalization to support investor sentiment amid significant global uncertainties. Fund managers and market experts say measures to deepen the cash market and attract long-term foreign capital will be closely watched when the finance minister presents the budget on Sunday. One of the key expectations is rationalization of the Securities Transaction Tax or STT, especially in the cash market, which investors say has lower trading volumes and participation than the derivatives segment, partly due to higher transaction costs.
Easy thing that can be looked at is the STT, especially in the cash market, because that is quite high in the cash market at 10 basis points compared to the brokerages that you are paying. Because the brokerages that you're paying is actually lesser, and SEBI has in fact recently come out with the circular saying that it should be reduced, at least for the mutual funds, right? So given that there is that pressure from the regulator on reducing the brokerages, and then there is also the interest both from the government and the SEBI regulator side to deepen the cash market compared to the derivatives market. There's a lot of data that has come out that derivatives is much larger compared to any other country in the world. Cash market needs to get larger. So I think one way to encourage that is to look at rationalizing the STT slightly.
STT is a direct tax levied on the buying and selling of securities on stock exchanges. At present, delivery-based equity transactions attract an STT of about 0.1%, while intraday trades and derivatives carry lower rates. Another key demand is the rationalization of long-term capital gains or LTCG tax to ensure stable foreign investment inflows.
Given the entire volatility, globally, there are talks around STT charges and LTCG. But more importantly, if you could get some benefit on long-term capital gains, I think that would ensure a lot more FII, FDI money pouring in from pension funds, sovereign funds, which is good to build a capital-intensive energy transition play in India.
Under current rules, gains from equity investments held for more than 1 year are taxed as long-term capital gains, while gains of up to 1,25,000 rupees a year are exempt. Any LTCG above that is taxed at 12.5%. The demand for tax rationalization comes amid heavy selling by foreign investors in domestic markets. In 2025, they sold equities worth over 1,66,000 crore rupees, the largest annual outflow on record.
India is in a very sweet spot, as they call it, Goldilocks moment. Low inflation, high growth, and the Indian growth story is being stamped by the rating agencies across the world, the big institutions around the world like IMF, World Bank. We are growing well above 7.5%. All projections are indicating above 7%. And on the other hand, there is a global situation where there are headwinds because there is so much of geopolitical and geo-economic uncertainty. So I think the budget is going to factor in these geopolitical and geo-economic uncertainties which are emanating mostly out of the US.
Experts add that while no major tax overhaul is expected, incremental steps to ease market friction, boost investor confidence and support sustained capital inflows could go a long way in strengthening domestic markets. The government's approach towards market-friendly taxation and capital market reforms will be closely watched.